In this video, we'll dive into what gamma scalping is, how it works, and exactly how you can use it to create success in your options trading. Investors should keep in mind that this method is highly complex and requires a thorough understanding of options trading to implement. Gamma scalping is a strategy used by options traders to make up for any lost premium due to the passage of time. It works by taking advantage of changes in the underlying price of the asset when there are large moves in either direction. When this happens, it creates an opportunity for traders to buy or sell call and put options at a premium and collect it as soon as possible. In other words, gamma scalping works by capturing profits from small price movements in the underlying asset rather than waiting for big moves that may or may not happen. Gamma scalping can be incredibly beneficial for long option holders because it allows them to make back any lost theta quickly and efficiently. When used correctly, it can help traders recoup some of their losses while also allowing them to take advantage of profitable opportunities in volatile markets. Traders like to scalp gamma to play with their delta exposure. And since gamma scalping relies on short-term price movements rather than long-term trends, it can be used even when markets are relatively stable and flat. This makes it an attractive strategy for those who want to stay active in the markets without having to worry about constantly predicting where prices will go over long periods of time. Trading around the underlying stock is a great way to manage your long options position. Exactly how this strategy works. Gamma scalping involves buying and selling shares of the underlying stock to offset the effects of daily decreasing theta, which is the cost of maintaining a long options position. The gamma scalping approach begins with a long straddle and adjusts when the stock price rises or falls. The initial setup consists of a long straddle with the same strike price. The transaction should be delta neutral, and investors are advised to exit at least 45 days prior to expiration, with 90 days being the optimal expiration period. If the stock price declines, investors will purchase X number of shares of the underlying stock based on the price change. If the price of the stock rises, they will sell shares short. Depending on the volatility of the stock they are trading, it is recommended to begin either purchasing or selling the underlying asset when their options have a minimum intrinsic value of $1, at which point, traders can use the underlying stock to lock in that value. Gamma scalping is not the same as a delta-neutral trading strategy. Traders who prefer no directional exposure will lean towards delta-neutral trade management. This is how professional traders focus on volatility rather than speculate on an underlying stock's movement. Options traders have a lot of tools at their disposal when it comes to managing their positions. The most basic approach is to cover their option and get out of the trade, but for those traders looking for more sophisticated strategies, there are two excellent techniques available: rolling your options into a spread to leverage implied volatility, and scalping gamma. Gamma scalping is my personal favorite as it allows you to adjust your position using the underlying stock while keeping your delta and Vega exposures low. Vega is a Greek symbol used to quantify how sensitive an options price is to changes in its implied volatility. It represents the amount by which the options price would change for every 1 point increase in implied volatility. If you're looking for a way to recoup losses from your long option trades due to time decay, consider implementing gamma scalping in your options trading strategy. This powerful strategy relies on short-term price movements rather than long-term trends, making it an attractive choice even during low volatility market conditions. At Masters in Trading, we offer educational resources designed specifically for those who want to learn more about this powerful trading strategy and set our members up to start using it with confidence. We also provide one-on-one coaching sessions so that our students can get personalized advice on how best to use gamma scalping within their portfolios. Closing thoughts on gamma scalping. Gamma scalping can effectively mitigate the consequences of theta decay on long positions while also assisting investors in properly hedging and managing portfolio risk in volatile assets. It can also be a suitable hedging method against directional exposure. However, investors should remember that gamma scalping can become highly costly in terms of trading costs and that it requires careful monitoring and a solid grasp of the fundamentals to be deployed rapidly. Traders must pay close attention to how changes in the stock price impact delta and gamma during the life of the trade in order to use the method correctly. Gamma scalping is a sophisticated options trading strategy that requires a thorough understanding of options trading to implement. It is used by institutions and hedge funds to manage portfolio risk and significant stakes in stocks and futures. However, with the recent evolution of retail trading and the industry-wide reduction of commissions, this method is now more accessible to retail traders. With our educational courses and one-on-one coaching sessions, you'll have all the resources you need to become an expert trader in no time. Jump into the markets with confidence today. Don't wait, head over to our website and read our latest blog post now.